Okay, class, it's Wednesday morning, so I am so late getting this video uploaded. We're going to try to finish the rest of the homework here in chapter 8 today so I can get a exam out to you today or tomorrow. All right, problem 34. Problem 34 goes back to this concept we talked about in chapter 2, this tax benefit rule. And so what we need to do is apply this tax benefit rule here. If Simon takes a standard deduction in part A, Simon takes a standard deduction, then he got no tax benefit from the tax from a tax deduction because he stuck to the standard deduction, and therefore his amount that he has to include from the refund is zero. Okay. In part B, what we have is we have itemized deductions are 10,350, which did not include the 2,650 of taxes that are withheld. So this is $1,300. Now this person's single, and so their standard deduction amount is $12,200, leaving a difference of $800. And that then is the amount of my tax benefit is $800, because if I'd had $800 less of that, I'd have taken the standard deduction. So here in part B of my refund amount, receives a state tax refund of $145 is the actual refund amount. So this is the amount then that's going to be included in my income, because my tax benefit was $800. My refund amount was actually only $145, and therefore the $145 is includable in income. In part C, we're going to kind of work it the same way, which is 9,650 plus 2,650 gives me 11,000 or 12,300. I take the standard deduction amount off of that is 12,200. 12,200. That leaves me with $100 of tax benefit. And that is the lesser of the amount. And so this therefore in part C now is going to be my income now that's includable in income. All right, so that's 34, 0, 145, and 100. Okay, next problem is 38. When I buy a house, there's going to be a couple of things that I'm going to do on my initial purchase of the house. And the first thing I'm going to do is I'm going to have to pay points. And points are just prepaid interest. And if I pay those points on my initial purchase of my home, I get to deduct that. If, however, it's a refinance, in other words, I already own the home and I'm just refinancing my mortgage, and I pay points, then those points have to be amortized then over the life of the loan. So what we have here in 38 is I have points that I paid of 2,500. I have 10,300 of interest that I paid. Gives me 12,800. That's my interest deduction now in the first year in which I owned this home. This is part A. In part B, we did a refinance. And this is March, so I'm going to take my 10,300 plus 2,500, my total points, divided by 15 years, because it's a 15-year mortgage, times 10/12. And whatever that number is, whatever the sum of those two numbers is going to be my deduction then in part B. Okay, problem 40. Problem 40 deals with charitable contributions of property. Now, when I make a charitable contribution of property, I'm allowed to deduct that contribution. Now, how much I'm able to deduct depends on really three things. Number one, whether it's ordinary income property, just for simplicity's sake, let's say inventory, or if it's capital gain property, let's say real property or stocks, and what my AGI is. Okay? So if the property I'm donating is ordinary income property, I can only take a deduction that's equal to basis. Okay? If it's capital gain property, let me go back. I can take a deduction equal to my basis, and my deduction is limited to 50% of my AGI. If it's capital gain property, I can take a deduction equal to its fair market value, but there it's limited to 30% of my AGI. Okay, so now let's look at this problem. We have property that has a basis of 38,000, fair market value of 54,000. So, in part one, if this is ordinary income property, my deduction is limited to $38,000, ignoring any AGI implications. If it's capital gain property, long-term capital gain property, my deduction is $54,000, again ignoring any AGI implications. Now, in part C, we're saying that my AGI is $60,000 times 50% would be $30,000. So I have a total of $38,000 that I donated. I get to deduct $30,000 in the current year with an $8,000 carryover that is available for 5 years. Carryover on charitable contributions is a 5-year carryover. If, on the other hand, this is capital gain property, I take $60,000 times 30% is $18,000. Gives me, I think, $36,000. Then carry over for the next 5 years. All right, and that takes care of problem 40. So now I want to just take a second and talk about problem 42. In problem 42, we're now going to apply the same rules to say which property should I go ahead and contribute. The ordinary income property, if I donate the ordinary income property, I only get a $41,000 deduction. If I donate this long-term capital gain property that has a basis higher than fair market value, then there's a $9,000 loss there that's lost forever. And if I decide I want to get rid of that property, I have to sell it for the fair market value of $75,000, donate the $75,000 cash, and take the $9,000 loss. So obviously the one that I should donate then is the one with the low basis, $32,000, with a fair market value of $75,000. And that then I can get a $75,000 that's again limited to 30% of my AGI. All right, 34 and 49, or 44 and 49, I'm going to skip. I'm now going to go to problem 52. And 52 will actually be the last problem that I'm going to do for today. I'm going to skip 55 and 57. So let's take a minute now and talk about problem 52. Okay, problem 52. Let me just talk about this child independent care credit. Number one, I get a child independent care credit for up to $3,000 for one child and $6,000 for 2 or more children. My credit, this is a credit, is anywhere from 35% down to 20%. And the way I do this first of all, if my income is $15,000 or less, my credit is 35%. So that makes it easy. If my income is $43,000 or more, then my credit is 20%. If I fall within the range from $15,000 to $43,000, I take whatever income I have, and let's say my income is $27,000. Minus $15,000 gives me $12,000 in excess of my $15,000. I divide that by $2,000 and I get 6. So I would take 6% off of the 35%. So I would take 35% minus the 6% that I lose in the phase out. So my credit would be 29%. Now let's assume that my income is $27,001. This gives me 12,000. This gives me 6.001 or something like that. In this case, in the case of this rule, we have to round up. So the rounding up of this 6% is now 7%, and I would be limited to 28% as the amount of my credit. So I take this excess over 15,000 divided by 2,000, and then whatever that fraction is, I round up. Okay? So now let's go through some problems. 52, starting with A. Okay, 52A. Michael and Gladys are married, have a 7-year-old child. Their adjusted gross income is $44,000, and they pay $3,300 in qualified child care expenses. Michael earns $12,000. Gladys earns $40,000. And so they're above the phase out of $43,000. So we're going to take this $3,000, because we're limited to $3,000 for one child, times 20%, is equal to $600. This is part A. Part B. Jill is a single parent, 11-year-old daughter. Her adjusted gross income is $24,500, and she pays $2,100 in child care expenses. So again, we're going to take this $24,500 minus $15,000 gives me $9,500 divided by 2,000. Gives me 4.75, I think. Rounding up is equal to 5. So 35 minus 5% that I lose in the phase out gives me 30%. So 2,100 times 30% gives me $630 as a child care credit. All right, part C. Corey is a single parent who earns $9,000 and receives other non-taxable government assistance totaling $5,700 during the year. Pays $1,600 in expenses. Well, here we don't have to count the non-taxable government assistance. So we're going to take my $1,600 times 35%, and I think that's $560 then the Corey gets then in each credit. Part D. Roosevelt and Myrtle are married and have 2 children. Roosevelt earns $94,000. Myrtle has a part-time job. She earns $4,400 during the year. They pay $4,700 in qualified child care expenses. In this situation, excuse me, my child care expenses can't exceed the earned income of the spouse earning the least amount of money. So here we're again at 20% because they're over the $43,000 threshold. But we're now not going to base it on the $4,700 of child care expenses, but on the earned income of the spouse earning the least amount of money times 20% is going to be $880. And part E. Randy can take child care expenses for his child care credit for his father. But again, he's limited to $3,000. So it would be 3,000 times 20% or $600. All right, so that's problem 52. I'm not going to worry about 55 and 57. And I'll try to get your exam out by tomorrow. By tomorrow afternoon. Needs to be your own work, but it can be open book, open notes, and no time limit. All right. Have a good Easter break. I'll talk to you then on next week. Thank you and have a great day. Bye.